Welcome to the All Financial Hour podcast with Steve All.
You know, the swings on Wall Street have been intense recently, and lots of folks out there panicking. But financial author Robert Prechter, he tells Fox Business that there's really no need.
To me, the key is to not worry too much about the day by day. You can see once the bear bites how much it can take away in a short period of time. The stock market has been the most overpriced and overowned it has ever been. So we're going to very calmly just sit and wait. And when everything changes and we see indicators on a long-term basis that are back at least in neutral, if not bullish, then we'll change our minds. But right now we just say stay in your bunker and watch the show.
All right, kind of like stay in your lane there. And, you know, there's lots of advisors out there, Steve, who would say, don't panic, stay the course. The market's going to come back. Don't worry about it. Is this good advice right now, or is there another message they should be listening to?
It all depends upon the person, the age, and the time they have in retirement and which accounts that we're talking about. You know, because market volatility is there right now. It jumped up when we brought some uncertainty into the election. We already had uncertainty around what's going on in Israel. We already had uncertainty about inflation, about what the Federal Reserve is going to do and interest rates. But the elections was pretty calm. And the main reason why it was, we had a ex-president running against a current president. So you didn't have as much uncertainty. If ex-President Trump got elected, we got a pretty good idea what he's going to do. And if Biden would have been reelected, we got a pretty good idea what he's going to do. But when Biden stepped down and Kamala Harris came in and Tim Walz came in, there's a lot of questions about what policies and which direction they're going to go. That causes uncertainty. Uncertainty causes volatility in the markets. And that's why we look at the point where I need the solution for almost everybody out there. If you're the ultra aggressive investor, we got solutions for that. If you're the ultra conservative investor, we got solutions for that. Steve, I do believe in what he said. I just want to buy it and hold it. It's going to be okay 20 years in the future. We have static investments that do that, but we all have tactical investments that say, hey, there are signs that the market is being in a negative position. Let's pull some of the money back away from it right now. And when the mathematical models say it's time to kick back in, it'll move the money back in. Because I always get asked the same question when I go talk to people. Steve, is it time to buy? Is it time to hold? Or is it time to sell? Let's take the emotions out of that. Let's use that methodical, mathematical, non-emotional to do that. If you're concerned about the current volatility in the market, give us a call now. Ask about Market Guard. We'll talk to you about how you can manage your portfolio in different ways. Again, ask us about Market Guard.
You know, Steve, for those that are thinking, all right, now's the time I'm going to sit down with Steve. What's that first appointment like?
That first appointment, when you come in, I'm going to figure out what your wishes, hopes, and dreams are. If you're from the radio, I usually ask, what brought you in? Why are you here? What did we talk about when you made the decision to pick up that phone and actually make the call? We're going to look at your wishes, hopes, and dreams. Then we're going to do an analysis. Are you taking Social Security? If you're not, what are your Social Security estimates? Do you have the option of a lump sum or a pension? How large of a nest egg do you have? And then we're going to boil it down a little bit to find out what the expenses are. Because I think that's the most important thing. People look for a number that they got to have in retirement. No, let's find out, what does your fixed income and your fixed expenses, is there a gap between those? And how do we fill that gap? Because the biggest question that most people want to know when they come into the office is, Steve, how am I going to recreate my paycheck in retirement? Because now I'm not going to work anymore, but I got to have the income that gives me a lifestyle. Call now. Ask about that comprehensive retirement plan, and we'll walk you through that first appointment.
Every year, Charles Schwab asks Americans how much money they think they'll need to retire. The new answer that came back was $1.8 million. The same as last year's survey. So does shooting for a specific number make sense, or do you find that that figure is more or less coming off the top of people's heads, Steve? And, when it comes to designing a plan, how do you allow clients to retire for less than 1.8?
Well, that's the the number. I remember the old commercials where people were walking around with their number. They all had different numbers flashing on and off. And the way about that would have to be recalculated every day, every hour, every minute. So it's not really a specific number. Yeah, 1.8 million, but you got to look at it. I always ask the question. People come into the office. Gentleman had $2.7 million saved. A couple comes into the office. They have $450,000 saved for their retirement. Which one do you think could retire? Everybody says, well, it's obvious, the guy with 2.7, because they just said if I got 1.8 million, he should be fine. Well, we did the analysis around the whole things. The guy with 2.7, he had about a $250,000 a year lifestyle, $20,000 a month.
Wow.
And if you just do the math and say that's $240,000 a year, without a lot of growth, he's going to go through the money in 10 years. And he was only 62 years old. So he didn't really have a good chance to retire. We ran the analysis around it and said at your spending levels, it's not going to work. He got mad and he left. Now, Kurt and Debbie came in. They had about $450,000 saved. They weren't sure if they could retire. But when we looked at the information that they had Social Security checks. Both had worked outside the home, so they had 2 Social Security checks. They both had pensions. And when we added up what the amounts that when they turned on their Social Security and they turned on their pensions, it was above their current living expenses. So they were actually going to save a little bit of money early in their retirement years. So when we look at that, we have to look at somebody, if you're in that situation and you don't have as much saved, but your lifestyle's being covered by your income, you could have a possibility if inflation got real bad further on down the road, but you've got that extra pillow. So it's not really exactly about how much you have is when you can retire. I say it's more about how much does your lifestyle cost you, because filling that gap is important. As I stated with the story that I told, the gentleman with 2.7, he needed to pull almost all of it out of the 2.7. The couple with 450,000, they weren't going to have to pull anything out until inflation caught up with them. So if you're uncertain or you're asking yourself that question, when can I retire? Give us a call. Let us run the Monte Carlo analysis, do a comprehensive retirement plan to help answer that question for you, even if you don't have $1.8 million.
A recent survey says that when it comes to claiming Social Security, nearly half of Americans misunderstand the rule about taking benefits early. The poll found that they think that if they start drawing the money at age 62, that the benefits will just automatically go up when they reach their full retirement age. It's not exactly the case, Steve, right?
No, yeah, that is not the case. No, that does not work that way. Once you turn on your Social Security, with about 1, maybe 2 exceptions now, once you turn it on, that's what it is for the rest of your life. Full retirement age is the benefit that you would get, and that depends on what year you were born when you hit that full retirement age. And you can take Social Security at age 62. Well, if you take it at 62, they're going to take a discount off of your full retirement age. You know, if you were born in I think it's 61, it's almost a 30% decline of what your full retirement benefit is. And you're locked into that benefit plus cost of living adjustments for the rest of your life. So we start to look at it and say, years ago, how did things work? When I hit 62, I'm going to retire, turn on my pension, and my Social Security. Today's world, that number has moved a little bit away from 62. It now goes to basically, a lot of people think I'm going to retire at 65, take my pension and my Social Security. So we look at it that way, and 65 is more geared for the fact that that's when Medicare kicks in than it is anything else, but you might not be at full retirement age. What I want to stress is they don't all have to happen at the same time. I can hit an age. I can retire. Most people, when they retire, if they're going to take a pension, turn on their pension then, if it's at all possible. But I don't have to take Social Security immediately. We look at it, and I've got like a rule of thumb. If you're a married couple, the lower of the two Social Securities, kind of take when you can. There's an annual earnings test. So if you're making over 20, I think it's 22,320, right at 23,000. If you're making more than that, they are going to discount some of your Social Security. If you're making less than that, you can make it. But until you hit full retirement age, there's an earnings test. The larger earner of the two, we want to delay that as long as possible. Why? Because every year you delay Social Security, it goes up by about 8%. People don't realize that if you take it at 62, if you wait till you're 70, it's about a 76% increase in that monthly check. But it's hard to do Social Security in a vacuum. We have to analyze, can you afford to delay taking your Social Security?
Right, yeah.
That's the big question that we have. Do you have too much money in your IRAs and 401ks? Can we spend some of that money down by delaying the Social Security so your required minimum distributions are smaller instead of having the big income that comes all your expenses? And then when you hit RMDs, it just kicks you up into a higher tax bracket. It's because people aren't real happy when they go, I wasn't paying any taxes on my Social Security and my pension, but I started getting this RMD and now I got to pay taxes on both. That's where we look at it. Social Security can't be done in a vacuum. We need to look at it tax-wise. How's it going to affect your tax? What's the best way to do it? Do you have the availability to delay? Social Security optimization is very important. It's not that simple. I turn 62, retire, and turn on my Social Security. Give us a call. Ask for the Social Security optimization, and we'll run the reports and look at it at what would be the optimum time for you to put on your Social Security.
We depend on financial advisors to let us know about ongoing changes in retirement laws, especially when it comes to taxes. So, Steve, I know this, but I want to let our listeners know you're educated and you're up to date on all these different changes. And what are some things that we need to know before the year ends?
I have a degree in accounting, and I've worked in the accounting departments for my own businesses for a very long time. So I do keep up with tax law so that we start to look at it. And I think reducing or eliminating taxes is the best thing you can do for your retirement. But we start to look at current, what's going on right now. If you had to take a required minimum distribution from a Roth 401k, laws changed. You don't have to do that anymore. The penalty, if you miss an RMD, used to be 50%. They've lowered it down to 25%. If you take care of it within 2 years, they'll lower it to 10%. And you still have the availability to ask for a waiver. One of the best things that I saw that happened is some employers, if you can make contributions to a Roth 401k, they'll put the match in your Roth account. Mm-hmm. But you have to pay taxes on the amount that they put in for the match. So there is a catch to it. It's not like you're going to get the money free. And they also are going to start next year for higher earners, those that make, I think, over $145,000. That catch-up provision, that extra money that you can put in after you get to the age, the only place you're going to be able to put that is in a Roth account. So there are a lot of things out there about taxes.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.